If you made exactly $184,500 in 2024, congratulations. You just fell into the IRS's favorite trap. In 2026, you'll pay $465 more in Medicare premiums, even though you didn't get a raise. Now, before you click away thinking this is another rich people problem, here's the kicker. This same mechanism is bleeding money from anyone making over $109,000. And the truly wealthy, they're not even playing this game. I'm going to show you the 3 moves they use instead. But first, you need to see how this trap actually works. Quick note before we dive in. This is educational content only, not financial advice. But your CPA probably won't tell you this stuff. Let's go. IRMAA. 4 letters that sound like a sweet grandmother's name. But it's actually the IRS's way of punishing you for saving too well. Here's how it works. At $109,000 in income, your Medicare Part B premium jumps. It goes from $202.90 to $284.10 per month. That's an extra $81.20 every single month, nearly $1,000 per year. But here's the thing. This isn't based on your 2026 income. It's based on your 2024 tax return. You're being punished for money you earned TWO years ago, when inflation was 30% higher, when gas was $4.50 a gallon, when your grocery bill was through the roof. Now, you might be thinking, I'm not retired. Yet, this doesn't apply to me. Wrong, dead wrong. If you made $107,000 in 2024, you're fine for now. But when you file that return in 2026, Social Security sees it. And in 2028, when you turn 65 and enroll in Medicare, boom, you're in the penalty zone. 2 years later, you're paying for income you barely remember earning. This is how Medicare became progressive income tax, disguised as insurance. You pay the same doctor, you get the same care, but you pay double the premium because you saved in your 401k. It's insane. But here's the kicker. So let me get this straight. A 64-year-old teacher with a $110,000 pension pays an extra $974 per year. Meanwhile, someone with $50 million in municipal bonds pays the base rate. That's $202.90 per month. How is that possible? Because IRMAA only looks at your modified adjusted gross income. Your MAGI and muni bond interest doesn't show up. Roth IRA withdrawals don't show up. Home equity loans don't show up. The wealthy aren't hiding money. They're just structuring it so it's invisible to the IRMA calculation. 3 strategies they use. Number 1, Roth conversions before retirement. Number 2, qualified charitable distributions. Number 3, municipal bonds for tax-free income. We'll come back to those. But first, let me show you the cliff, the one that'll really make your blood boil. Here's where it gets mathematically insane. If you and your spouse earned $218,000 in 2024, your premium is $284.10 each. That's $568.20 per month total. But if you earned $218,001, just $1 more, you jumped to the next bracket. $487.00 per person. That's $974 per month. You made $1 extra, and you lose $4,870 per year. Your effective tax rate on that dollar? 487,000%. Let me say that again. 487,000%. Effective tax on $1. Now here's what'll really make your blood boil. Congress members don't deal with this. They're in the Federal Employee Health Benefits Program, not Medicare. They designed a trap they never fall into. They vote on IRMAA thresholds. They decide the brackets. But they don't pay it. It's us versus them. Rule makers versus rule takers. And we're the ones getting bled dry. So what are the actual 2026 brackets? Let me break this down simply. 4. Married couples filing jointly based on 2024 income. Under $218,000, you pay the standard premium, $202.90 per month. Between $218,001 and $274,000, you pay $284.10. Between $274,001 and $342,000, you pay $405.80. Between $342,001 and $410,000, you pay $527.50. Between $410,001 and $750,000, you pay $649.20. Above $750,000, you pay $689.90. Notice the pattern? The biggest jump happens at the first threshold, $218,001. That's where the trap is set, because that's where most successful savers land. 2 teachers with pensions, 2 government workers with decent 401 kiloseconds, a small business owner and a nurse. The truly rich, above $750,000? They're laughing, because they've already restructured their income. They show 0 on their MAGI. Now here's the thing most financial advisors miss. This is a 2-year look back. You can't. FIX 2024 now. It's done, filed, locked in. But 2025 income determines your 2027 IRMAA. Small moves you make this year save you massive money in 2027, and that's where the 3 countermoves come in. Let me show you exactly what the data suggests works. Countermove number 1. The Qualified Charitable Distribution, or QCD. This is for people age 70 and a half or older. If you have a traditional IRA, you're required to take minimum distributions. Those RMDs count as income, and they spike your MAGI. But here's the loophole. If you redirect up to $105,000 per year directly from your IRA to a qualified charity, it doesn't count as income. It satisfies your RMD, but it's invisible to IRMAA. Example, let's say your RMD is $25,000. Normally, that $25,000 pushes you over the $218,000 threshold. You're in the penalty zone. But if you donate $10,000 of that RMD as a QCD, your MAGI only goes up by $15,000. You stay under the threshold. You avoid $4,870 in IRMAA penalties. You just turned a $10,000 donation into a $4,870 discount. That's a 48% return on charitable giving. Countermove number 2. The Roth conversion sacrifice year. This one's for people who are 5 to 10 years away from Medicare. Here's the idea. Right now, your traditional IRA is a ticking time bomb. Every dollar in there will count as income when you take it out. And when you're 72, you're forced to take it out. But if you convert it to a Roth IRA, before you retire, you pay the tax once. Then it grows tax-free. And when you withdraw it in retirement, it's invisible. To IRMAA, 0 MAGI impact. But here's the thing nobody tells you about Roth conversions. Timing is everything. If you convert $100,000 in a year, where you're already near the threshold, you trigger a penalty. 2 years later, you shot yourself in the foot. But if you do it in a low-income year, everything changes. A year you took unpaid leave. A year you had a business loss. A year between jobs. You pay the tax at a lower bracket, and you avoid the IRMAA trap entirely. Example, you're 60 years old. You got laid off. You're living on savings for 6 months. Your 2025 income is only $60,000. Perfect. Historical data shows people in this situation often convert $50,000 from traditional to Roth. Pay tax on it, sure, maybe $12,000 in federal tax. But that $50,000 is now tax-free forever, and it'll never trigger IRMAA. That $12,000 you paid, it potentially saves you $4,870 per year for the next 20 years of retirement. Do the math. That's $97,400 in IRMAA savings for a $12,000 tax bill. 8-to-1 return. But you've got to model this. Don't just guess. Use tax software or pay a CPA $500 to run scenarios. Because if you do this wrong, you create a penalty instead of avoiding one. Countermove number 3. The HSA Triple Play Health Savings Account. If you're on a high deductible health plan, you can contribute up to $8,300 per year as a family. If you're 55 or older, add another $1,000. Every dollar you put in reduces your magi. It lowers your taxable income today. It grows tax-free. And when you take it out, for medical expenses, it's tax-free. No IRMAA impact, ever. This is the only account in the U.S. tax code with a triple tax advantage. Deductible going in, tax-free growth, tax-free coming out. And it's invisible to IRMAA. But here's what most people miss. If you're 58 years old right now, and you max out your HSA for the next 7 years, that's $58,000 in contributions. It grows to maybe $75,000. And when you're 70 and you need dental work, hearing aids, long-term care, you pull from that account. Zero magi impact. Zero IRMAA penalty. Most people don't even open an HSA. They pick the safe PPO plan, and they lose $75,000 in tax-free money. Now you have 11 months. That's it. Whatever your 2025 tax return says will determine your 2027 Medicare premiums. Miss this window, and you're locked in. Now, the IRS does have an appeal process. It's called life-changing events. You can file Form SSA 44 if something major happened. Your spouse died. You got divorced. You stopped working. You lost your pension. But here's the brutal truth. Historical data shows only 14% of appeals succeed. They'll approve it if your spouse died. Maybe if you got divorced, lost your job. Maybe market crash tanked your portfolio. Good luck. The SSA doesn't care that inflation ate your savings. They don't care that your 2024 income was an anomaly. Maybe you sold a rental property. They look at the tax return, and they apply the penalty. Cold, mechanical, automated. Now here's the move almost nobody considers. If you're self-employed, or you do consulting work, you might have control over WHEN you get paid. You can potentially manipulate the timing. Defer income to January 2026. Accelerate deductions into 2025. Example, you're a consultant. You've got a $30,000 project wrapping up. In December 2025, you're already at $215,000 in income for the year. If you invoice that project in December and get paid in December, you're at $245,000. You just triggered the IRMAA penalty for 2027. But if you invoice it in January 2026, it counts as 2026 income. It affects your 2028 IRMAA, not 2027. You just bought yourself a year. And maybe by 2026, you're in a lower bracket, or you've done AQCD, or you've maxed your HSA. Same thing with deductions. If you're Going to donate $10,000 to charity? Consider doing it in December 2025, not January 2026. If you're going to prepay your property taxes, do it in 2025. If you're going to make a big IRA contribution, do it in 2025. Create a $10,000 buffer below the next threshold. That buffer is your insurance policy against an unexpected bonus, a surprise capital gain, a random 1099 you forgot about. This only works if you control the timing. If you're a W-2 employee with a fixed salary, you can't do this. But if you're self-employed, semi-retired, doing consulting, contract work, you have options. So, here's the bottom line. The IRS didn't create IRMAA to punish success. They created it to extract maximum revenue from people who don't know the rules. Every dollar you pay above the base Medicare premium is a dollar gone. That could be in your grandkids' college fund, or your emergency medical fund, or literally anywhere else. The 1% aren't smarter than you. They just have accountants who do this math for them. Now you do too. One last thing before you go. I made this video because my dad got hit with $3,100 in IRMAA penalties last year. He didn't even know it existed. He worked 40 years as a union electrician, saved every penny, did everything right, and the system punished him for it. So if this video just saved you $4,870, hit the subscribe button. It's cheaper than a CPA. And if you want my IRMAA bracket sheet with all the 2026 numbers, I put a link in the description. It's free. Print it. Give it to your tax guy. Give it to your parents. Next video, I'm breaking down the $22,000 mistake retirees make at age 65. It's about Social Security. Timing and historical data shows it's costing people their entire first year of retirement income. I'll see you there.